Make money avoiding these 10 advanced investor mistakes. A successful investment plan requires knowledge, patience, research, and discipline. Many people who start investing in stock markets tend to have their savings wiped out within a few years because they make one or more of the common investment mistakes. Whether you're a beginner or an intermediate in managing your funds by yourself, you would not want to wash away your hand-earned rupees due to market uncertainties. So in this video, we will tell you about make money avoiding these 10 advanced investor mistakes. The video is amazing, so stay till the end. But before we start, don't forget to subscribe to our channel and hit the bell icon to get started. Number 10. Don't put all your eggs in one basket. It's the basis for almost everything you deal with in your life. Diversify your investments. Never put your eggs in a basket. For example, if you invest all your money in stock markets, you're not diversifying your portfolio, you are exposing yourself to unwanted risks. Likewise, if you only invest in secure instruments such as bank FDs or NCSCs, you will not be able to get the best return on investment. The lowest mortgage rates at Kotak Mahindra Bank. To effectively diversify your portfolio, you should invest some of your money in a high-risk, high-return instruments and some in safe, low-return components. You are therefore on the safe side in case of problems. Number 9. Do not be impatient to invest. Patience is the key to invest planning. Making money takes time and effort. If you look for stories of people who have been tricked into investing, you will invariably find that most people acted quickly. No matter how much you trust a person making the investment proposition, no matter how much urgency they create, never act quickly. Never lose patience. You would see many scams and money circulation schemes that promise very high returns, but require an immediate investment on your part. Any investment that requires immediate action should sound the alarm. Charlie Munger said, "Waiting is good for investors, but many people can't wait. If you don't have the gene for future satisfaction, you'll have to work hard to get over it." Number 8. Don't ignore investment research. And investment research will only be successful if you've done enough investment research. The more I learn to invest, the more I learn. The more you talk to people about it, the more likely you're able to be successful. If you want to invest in the stock market, first take a market course and trade online. If you wish to invest in Indian government savings schemes such as PPF, National Savings Certificate, etc., please read all terms and conditions on the respective government website. The more investment research you do, the better your investment decisions will be. Number 7. Don't stick to one company. Every organization has its level of learning for the type of people they work for. The level of learning varies from company to company and from the environment to environment. I've seen that people have different level of learning in every company they have worked for. Some of them told me that due to the huge population of a particular company, you have unlimited freedom, especially in the IT industry, where people have comfortable positions. Unconsciously, their learning level drops to the point that after a few years, when they sit down to create their profile, they realize how little they have learned. If you want to keep up with the businesses and markets, you need to keep an eye on new trends and technologies. You only grow through learning. Number 6. Don't move too many investments. Your investment must be consistent. Remember, investing is a long-term game. After watching a company's stock price rise for a while, you feel the need to move your investment into that company. The simple fact is that when you buy a stock, you pay a commission. As you continue to buy and sell, you will end up paying more commissions than you earn from your investment returns. When we talk about diversifying an equity portfolio, we mean an investor's attempt to reduce their exposure to risk by investing in a variety of companies from different sectors, or countries. Most investment experts agree that diversification does not guarantee a loss, but it is a prudent strategy to follow for long-term financial goals. Many studies are showing why diversification works. Simply put, by spreading your investments across different sectors or sectors that have little correlation with each other, you reduce price volatility. This is because different industries and sectors do not move up and down at the same time or the same rate. Messing things up in your portfolio is less likely to see significant declines because while some sectors are going through tough times, others may be doing well. This ensures a more consistent portfolio performance overall. Number 5. Don't wait for your revenge. When you buy a stock and it starts losing money, you have to decide what you need to jump ship quickly. Many people think that they should wait a while after investing in stocks. On the other hand, if you've held a stock for a while but see that you are losing money as a pattern, you should decide to exit before you end up losing more money. Don't wait for your investments to stabilize. Know when to cut your losses and take a step back. The stock market is not supposed to be safe. There are always situations where some win and others lose. Number 4. Do not borrow for investment. Many people get confused when they see stocks that offer impressive returns. You think you should get into stock market fads. It doesn't matter if you've invested money and are willing to take risks. The problem occurs when people think that they should start investing by taking loans. Personal loans are the common entry point for this fallacy. Imagine taking a 14% interest rate loan to invest in the stock market and getting stuck with its EMI when the return on your investment might come after some time or might not come at all. The only time it makes sense to get a loan for an investment, called an investment loan in financial terms, is if the loan has a high return on investment and the level of investment risk is low. Investors are advised not to invest their loans in risky instruments such as the stock market or derivatives. Also, once an investor gets a loan, it makes no sense to put money into an investment that will mature after the loan repayment date. It's also important for investors to ensure that the return on investment exceeds the cost of the loan. Deposits and bond certificates fall into this category, as are investments that mature within 90 months and account for more than 10% of borrowing costs. Number 3. Don't try to determine the time of the market. One thing that even Warren Buffett doesn't do is time the stock market despite having a very strong opinion on the price level of each stock. But most investors do the exact opposite, which financial planners have always warned against, and lose their hard-earned cash. So don't try to time the market. No one has successfully and consistently done this over multiple trades or stock cycles. Reaching ups and downs is a myth. It's the same today and it will be the same in the future. People lose more than they gain, said Anil Chopra, Managing Director of Group Director for Bajaj Capital Group. The market moves periodically and all kinds of indicators reflect the phase of the market, at least at any given time. However, this does not necessarily mean that you can accurately and consistently determine entry and exit times. Number 2. Do not let your emotions in the way. Some cycles are more predictable than others, but the presidential session, others will be the most difficult. Market cycles can last from several weeks to several years and can vary from investor to investor. Real estate investors are more interested in the duration of the contract, but day traders consider how cycles can affect their trades in hours or minutes. However, market timing is difficult because many investors have their strategies and act on their own. This can delay or confuse the market and make timing difficult where there is a clear movement. For example, low interest rates can hurt the banking sector, but can be beneficial for those interested in real estate. Number 1. Following bad advice from social media. I'm afraid of the misinformation about investing and financing in general, especially on social media, Harrison says. The general advice from experts is simple. Do not follow investment advice from people who do not know your personal financial situation. For example, you may be pressured by someone on social media to start investing in a particular company, but they are unaware of other investment options you may have. It may be better to put the money into your employer-sponsored retirement account, especially if your company matches a certain percentage of your salary. When investing, make sure to do your research and find out who is providing financial advice on TikTok or any other social media platform. Whether you're just starting out or a more experienced investor, a good place to start is FINRA's free online education program for investors. That's all for today. I hope you liked the video. Don't forget to subscribe to our YouTube channel. Press the bell icon for more updates and notifications. Stay safe, and we'll be back with another video soon.